Hello, my name's Heath. I'm going to give an informative speech here at the 8th Avenue Street Fair here in New York City. I'm going to be focusing on a subject called structured finance, and we're going to pinpoint that into a certain area called mortgage-backed securities, which is just a piece of structured finance. And the whole point is we're going to go through this entire transaction process of a mortgage-backed security, so my audience is going to understand a mortgage-backed security from the beginning to the end. You're also going to understand how it's profitable, and if it's not used properly, how it can lead to a financial collapse like we're all used to in 2008. So starting here with the mortgage-backed security, back in the good old days, as a borrower, you would just go to the bank if you wanted a house, like you and I would. You'd go to a house and you would ask the bank for a loan. And so we would go to the bank, you would get a loan, and you would pay on a 15 to 30 month, 15 to 30 year interest, the bank gaining principal and interest, and everybody's happy. But during the early 2000s, what happened? So anyway, that's traditionally how a loan would work. But during the early 2000s, when you had the dot-com bubble, you had the 9/11, Alan Greenspan had to come in, lower interest rates to around 1%, and this left a lot of easy money, a lot of easy capital into a lot of investors' hands. They had nowhere to put it. Traditionally, you would put your money into U.S. Treasuries, stocks and bonds and notes, gaining 4 to 5% interest. Well, at this point, there was 1%. People weren't happy with that. So what they decided to do was they decided to take the cash flow, and let's say this bank here, which is just your local bank in your neighborhood, say they had $1 billion worth of cash flows from mortgages. So what would happen is the bank would receive those mortgages, and they would wait 30 years, and then they would earn money. But these investors came up with an idea: let's use the cash flow of these borrowers, and we'll turn that into structured finance and gain a nice profit. So anyway, what happened was these banks and this investment bank, these banks would package it up, and they would call them what you all know as mortgage-backed securities. So this investment bank would then buy the bank's balance sheet, which in this case, our example is $1 billion. So now the borrowers that are giving money to the bank, now the investment bank is receiving that money. So now all the cash flow is going into investment bank. Now the purpose for the investment bank, you might hear the word arrangers or managers. They manage these assets. They're not looking, in theory, they're not looking to make a profit off of that cash flow. What they're trying to do is they're just here to manage it, and they have to abide by these capital regulatory regulations. So what they'll do is they'll set up kind of like a special purpose entity or a special purpose vehicle. And what that means is it's a subsidiary company to this investment bank. It's basically bankruptcy remote. So if this investment bank, for instance, this would be like a Goldman Sachs, if this investment bank goes under, then this special purpose vehicle that's a subsidiary company of the investment bank, that those cash flow assets are not harmed. It's not going to be bothered by the investment bank at all. So what happens is, so now you have this special purpose vehicle that's receiving that cash flow from our original borrowers. And so what this special purpose vehicle will do, it'll distribute stocks or notes. Say it distributes 1,000 shares. And so these shares are then sold into these different levels, which you have low risk, medium risk, and high risk. And you might have heard of this, but that is actually called a collateralized debt obligation. So what that means is, the low risk, say they'll offer 4 or 5%. The medium risk will be around 6%, and the high risk is 7%. So like hedge funds, small-time investors, they will invest in these different levels, which are called tranches. And what they'll do is they'll earn a monthly interest rate at 5%, and which is a whole lot better than our traditional 1% that the government offered. So everybody was happy. So as you can see, as this transaction from the bank to the investment bank to the special purpose entity or vehicle into a collateralized debt obligation, it's a pretty good transaction process that can be pretty profitable. Now, if it messes up, it's a little weird out here. If it messes up, what happens is, during the early 2000s, these banks had a lot of leverage, and they were able to they had a lot of access to credit, and a lot of money in their pocket, they over-leveraged themselves, and they started allowing bad subprime mortgages into this transaction process, which then when you start allowing bad investors into this transaction, it makes it, you have a lot of assets and a lot of cash flow problems, and then all that together will cause a financial freeze, which is what we're used to. So yeah, I've been doing an internship at Fitch Ratings, and that's what we do is we basically analyze the structured finance from mortgage-backed securities, and that's pretty much it. Just to let you know that the FOMC, they said anywhere from around 2007 to 2009 it was about $1.6 trillion that was actually invested into this system. And then you can see, once you have supply exceeding demand, the value of the houses will go down, and there's no more cash flow, and then you have a financial disaster. But that's pretty much it. Thanks for listening.